Today we're going to talk about something that can accidentally trip up investors when trying to claim tax deductions, the superficial loss rule. If you invest in stocks, ETFs, or mutual funds and you're using tax loss harvesting to offset capital gains, this is something you need to know. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. What is the superficial loss rule? The superficial loss rule is a tax rule designed to prevent investors from claiming artificial capital losses. It applies when you sell an investment at a loss in a non-registered account. You, or someone affiliated with you, buys back the same or identical investment within 30 days before or after the sale. You, or the affiliated person, still owes that investment 30 days after the sale. If all these conditions are met, the CRA will not allow you to claim the loss on your taxes. Instead, the loss is added back to the adjusted cost base of the repurchased investment, which affects future tax calculations. Let's say you bought 100 shares of a stock for $10,000. The stock drops and you sell it for $7,000, creating a $3,000 capital loss. If you or your spouse buys back the same stock within 30 days before or after the sale and still hold it 30 days after, the CRA won't let you claim that $3,000 loss on your taxes. Instead, that $3,000 is added to the cost base of the repurchased stock, meaning it will reduce future taxable gains if you sell again later. Who counts as an affiliated person? The superficial loss rule doesn't apply just to you. It applies to anyone affiliated with you. This includes your spouse or common law partner, a corporation controlled by you or your spouse, a partnership where you or your spouse are the majority partner, a trust where you or your spouse are the main beneficiaries. Who isn't considered affiliated? Parents, children, grandparents, siblings. So, for example, if your spouse buys back the same investment within 30 days, the superficial loss rule still applies. But if your sibling or adult child buys it, the rule does not apply. What counts as identical property? The CRA defines identical property as investments that are the same in all material aspects. For example, 2 shares of the same stock, even if purchased at different times. 2 ETFs that track the exact same index. Mutual Fund A and Mutual Fund Series F. Same fund, different fee structures. However, 2 stocks from the same industry, example Bank A and Bank B, are not identical. 2 ETFs tracking different indices are not identical. This means you can avoid triggering the rule by buying a similar but not identical investment. If you want to realize a capital loss without having it denied, here are some strategies. Wait at least 31 days before repurchasing the investment. Buy a similar but not identical investment. Example, sell a Canadian stock ETF and buy a Canadian dividend ETF instead. Avoid repurchasing an investment in a registered account like a TFSA and RSP. Losses transferred to a registered account are permanently denied. Let's say you want to sell an ETF that tracks the S&P or the TSX Composite Index. Instead of buying the same ETF back right away, you could buy a different Canadian ETF with slightly different holdings. This way, you stay invested in the market but still benefit from the tax deduction. Let's answer some common questions about the superficial loss rule. What happens if I trigger the rule? If the rule applies, your capital loss is denied for that tax year. Instead, the loss is added to the cost base of the repurchased investment, so it might still benefit you when you sell in the future. Does the rule apply to RSPs and TFSAs? Yes, but in an even worse way. If you sell an investment at a loss in a non-registered account and repurchased it in your RSP or TFSA, that capital loss is completely lost forever. It won't be added back to your cost base or carried forward. Can I still claim a partial capital loss? Yes. If you sell only a portion of your shares and repurchase some, but not all, only part of that loss will be denied. Does this apply to mutual funds? Yes. If you sell a mutual fund and buy back the same fund, even with a different fee structure like a Series A and a Series F, the rule applies. Should you worry about the superficial loss rule? The superficial loss rule is something every investor should be aware of, especially if you're using tax loss harvesting to reduce your tax bill. Here's what you should do next. Check your portfolio. See if you have any investments with unrealized losses. Plan your trades carefully. Avoid repurchasing identical investments within 30 days. Use alternative investments. Switch to similar but not identical assets to stay invested. Consult with a tax professional. If you're unsure, get expert advice to avoid making costly mistakes. Understanding the superficial loss rule can save you from tax surprises and help you maximize your deductions. If you found this video helpful, don't forget to like and subscribe for more financial planning insights. Thanks for watching, and I'll see you in the next video.